Welcome, everybody. Happy New Year. This is Axel Merk, President and Chief Investment Officer of Merk Investments, with our latest U.S. business cycle chart book, prepared as always by Nick. I am recording this in-depth commentary on Monday, the 7th of January. Of particular relevance is, of course, the various gyrations we've had in the markets. Lots of talk in recession may be imminent, how the Federal Reserve is now going to cut rates rather than to hike rates. Lots of stuff has changed. And obviously the question is, what's going on? What's happening? Are the data all wrong? And one of the things we try to do is try to look at the consistent set of charts to go through the clutter, to make up our own mind. The reason why this is relevant is because the stock market has historically done far better during economic expansions than during recessions. And there's a big caveat that we often only know about the recessions with hindsight. And so what good does it do if the markets have already come down so much? Some people ask, well, that was a question from a few days ago. They've obviously surged back. And so if you're not confused, you're probably not paying attention. But maybe more relevant, and I'm publishing an insight on this in the near future, is that maybe policymakers, notably the folks at the Fed, are at least as confused as you may be, and that may well be contributing to the market volatility. In discussions with Nick, he has referenced the downdraft we had in stocks a little bit to a slow motion 87 crash. The reason he said that is because the business cycle seems to be doing just fine, yet the market is coming down with these major surges back up. Now, whichever it is, when the markets go down, it's obviously never so pleasant if you're invested in stocks. We've been preaching, obviously, diversification for quite some time, noting that volatility should be rising, which indeed it has. But where are we, and is worse to come for, or is this a buying opportunity? And so let's talk about some of the things that are happening and move here through these charts. Leading economic indicators are doing fine. They have come down a little bit of late, but are clearly in positive territories. If you go through past recessions, they have historically been negative. Now, some people have talked about the revision of data and so forth. Some data get revised, others do not get revised. And so I'm just giving you these numbers here as a reference point. And the short of it is, we don't think the economy is falling off a cliff. The steepness of the yield curve, historically a leading indicator of recessions, but there have been false signals, meaning false signals in the sense that it's taken an extended period before a recession happened afterwards. There's always been a recession at some point. So the folks who said that a yield curve inversion has always been followed by recession, of course, they're technically right. But is there recession within a reasonable time frame? Steepness of the yield curve, obviously the relationship between short-term and long-term rates. We choose on this chart 10-year yields versus the 3-year yields, mostly because of the ease of data availability. But you can do the same thing with 2 years versus 10 years, which is a more common way to look at it. Important and relevant, we have not had an inversion of the yield curve. And even once we've had an inversion, historically, it's taken several months before then we would have had a recession. And again, there's usually a reason why the yield curve inverts, and I've mentioned this many times on when looking at these charts, is because the inflationary pressures are increasing and the Fed is inclined to move rates higher. PMI, Purchasing Manager Indices, have plunged, was the headlines. Well, they're still above 50. Above 50 is expansionary. Now, could it be that it's not fully reflective of a downturn? It's certainly possible. On the global PMIs, China below 50. I mentioned before, China may be more relevant than many things. We talk about Brexit a lot and whatnot. China is a big elephant out there. And yes, what's happening in China is relevant, and it is a noteworthy highlight. Now, if you think about it, what's been happening? We've had the flare-up in emerging markets. We've had, both on some currency sides, we had some flare-ups on financing, on the debt, on the rates blowing out, so to speak, in emerging market, and it's been gradually coming inbound towards the US. The mandate of the Federal Reserve is not to manage what's happening in the rest of the world. Its only mandate is to worry about the rest of the world to the extent it affects the US economy. And so as rates have been moving higher, this tightening of the financial conditions, which, by the way, is the whole point of hiking rates has gradually made it onshore. And so the question is it now, are we at a stage now with rates where conditions are quote unquote so tight that it is slowing down the economy? Or is it, as we just heard a few weeks ago still, that the foot is still on the accelerator, right? If you look at the latest FOMC statements, we're now at a range where some at the Fed think that we might be in neutral territory. All of this in the context of the unemployment rate being very low. Now, we draw this moving average here as well, and if and when we should break through that, the moving average, that might be an indication that we might be heading into a recession. Keep in mind that this unemployment rate moved higher on the backdrop of a higher labor participation rate. That means more people joined the labor force and want to get a job. So we're not at a stage where people don't find a job. We're at a stage where more people want to have a job. And so is this the end of the good times? Maybe. This is another unemployment model that you can look at in more detail. There's some models on capacity utilization. Those sound like we're stretched, right? So we could be falling off a cliff. And by the way, falling off a cliff is certainly a possibility. Recessions in the past we've had good times, and then suddenly after the euphoria, we realize how quote unquote bad things are. So it is not completely out of this world to suggest that things may be turning, but we'd still like to have a few more indicators than what we see right now. The so-called output gap. Remember, these are estimates, in this case of the Congressional Budget Office. Take them a bit with a grain of salt, how relevant they are, but they are data points we like to look at. The Atlanta Fed GDP Now forecast, as volatile as it is, this gray line has been a reasonably good indicator of where GDP is heading. I like to point to this chart here because I think it's most relevant. The US consumer is doing extraordinarily well. The delinquency rates are very low. Now, delinquency rates are still higher than they were at some low points here before the 2008 crisis. There's still certainly some things to be worked through. But generally speaking, the US consumer is well behaved. The US consumer also was spending money well and so forth. The folks who have problems, if you listen to the headlines, if you recall, the company that gave a profit warning, and this is not investment advice, was Apple. And they blamed China. Now, is it that the iPhones are overpriced, or is it that China is slowing down? It certainly jolted the markets, but the relevant part is still that the issues are abroad. The S&P 500 companies, large companies, they do a lot of business abroad. Now, clearly, if they don't do well abroad, maybe it affects US hiring as well. But at this stage, just take a company like Apple that announced big expansions in building more sites in the US. That doesn't sound like there is a tremendous pullback in the US. It might mean less profitability in the US, and that might be bad for stock prices. But US consumers, here again, they're doing just fine. Yes, there has been a little downtrend. And on that note, on a contrarian indicator, of course, yes, very high consumer confidence is a contrarian indicator. But I hope we get to this chart here. Well, this is one other data point. The bank lending standards. This is the sort of thing that the Fed looks at. A loan officer survey actually asking people, they say the lending standards have not tightened significantly. Now, you say, how is that possible with high yield spreads moving higher and so forth? Here we see a surge in high yield spreads. Yes, they have been moving higher, but keep in mind, this is the spread between treasuries and high-yielding securities. To a significant extent, this is due to the fact that treasuries have been rallying. And so, yes, this is a cautionary tale here, but the borrowing costs haven't necessarily surged for many of these borrowers, especially access to credit. Let me go back here to this previous chart, is still quite available. But what's happened is that there has been a major rally in the safe asset, and yes, there's been a sell-off in the risk assets. But the question is, have things really deteriorated so much for the high-risk borrower? Building permits here, yes, there are signs of things topping out, but things can top out for a while. I'm not suggesting that we're not in a late stage of an economic expansion. I'm just questioning whether we really are at this stage in the economy where things are about to turn over. Let me see whether I can get to my next page here. Sorry about that. Here we go. There we go. Yeah, so if you look at this checklist here that Nick puts together, a bunch of positives, bunch of negatives. In the short term, though, his assessment is we're still on the positive side. Let me add here a few things, not necessarily reflected on these charts. I just mentioned treasuries have been rallying. So to a significant extent, the sell-off in risk assets may well be related to the confusing signals we're getting from the Fed. We get them jolted up, jolted down. We also had, quote unquote, everybody agreeing treasuries should be rallying a few in the third quarter, at the end of the third quarter, beginning of the fourth quarter. And so there was a lot of short covering in that market. And then we had on low liquidity all kinds of odd moves. So if you looked at the markets beginning of the year, suddenly things were breaking down, and suddenly everything is great again. Going back to what I said in the beginning, Federal Reserve is now, the market is now pricing in for the Federal Reserve to have peaked out just about on the rate hikes. I don't think that's the case yet. And this is a business chart book, so we don't go into some of those charts here. But notably, what's not on here, and what the Fed, in my view, is missing, is the wage pressures moving higher. Wages are moving higher. Now, Powell, the head of the Federal Reserve, has been shrugging off those concerns, saying, hey, we have increased productivity. Yes, productivity has increased a little bit, but not that much, whereas wage pressures are truly accelerating, spreading out, being broader. And that may be a good sign of a strong economy. It is also, though, a sign where the Fed, in my view, should not have the foot on the accelerator, not be in neutral, but be ready to be tightening. And that's not what the Fed is up to. And so I have a bit of a feeling that Powell, head of the Federal Reserve, is being chased around by the markets. And he's backed off from his comments that, oh, we want to have a separate, we don't want to have separate levels on interest rates and quantitative tightening. Now, a few days ago, he brought it into play that, oh, maybe we are flexible. Maybe we didn't mean it, that we want to be so tough on the markets. What's happening here, in my view, is that profitability of companies is eroding. Now, some of that is just the year-over-year comparisons that are tough. Some of it is the tough international environment. And so there are several of those factors. And then importantly, there's wage pressures. And there's also, when companies invest more, that might reduce profitability. But none of that means that inflationary pressures are going to disappear. In fact, it means that we're going to use more resources putting upward pressure on prices. And I believe the Fed would be well served if they gave more than lip service to that, or if they at least gave lip service to that and were to consider that. Now, obviously, just because I think the Fed should do something doesn't mean they will. I do think, though, that yes, the glass is half full on the day that I make this recording, and we'll have more of these glass half full days, and I wouldn't be surprised at all if those rate hike expectations will increase. Now, what does that mean? That means that volatility is going to be here to stay, in my view anyway, because as rates go higher, risk premia go higher, this higher volatility environment may well persist. Profitability may be lower, and that may not be so good for risk assets. And so, yes, I do think it is possible for the stock market not to do so well. Obviously, volatility being part of that. And so all of that suggests to me that this diversification, if investors haven't done it, it's very high time to do it. And by the way, as the market thinks that we have topped out on the interest rate cycle, on the day as I speak today, the dollar is substantially weaker. And we haven't even talked about the rest of the world. This is not the chart book to do this. We are still expecting that the ECB might maybe hike rates. And so suddenly we're at the tail end of this environment where the US had the cleanest of the shirts. And so all of that suggests that there's some significant asset reallocation. And many people haven't done it because they've been worried about having to pay taxes if they sell any of their securities. Any case, this is the Business Cycle Outlook. Make sure you're subscribed to our newsletter as well. You'll get informed not just of the research report updates, but also of Merk Insights. Give us feedback, how you like these, and that's it. Have a wonderful year. Have a profitable year. Reach out to us if you have any questions or if we can be of service. Take care.